Hi there, welcome to Kneppy Invest. We are at the start of June, which means not only is June my favourite time of year, mostly because it is my birthday, but I also like June in Brisbane. June, July, August, September, wonderful time to be living in Brisbane. Beautiful weather. Might start out a little bit cool in the morning, but warms up really nicely. Beautiful, crystal clear, blue skies most of the times. And if I had to choose one capital city to live during this time of year, it would definitely be Brisbane. I have lived in Melbourne and Sydney this time of year, and Brisbane absolutely beats those two locations hands down. If you'd like to argue with me about that, I'd love to hear your comments. But this video is not about which capital city is best to live in June. It's all about the performance of three portfolios I am tracking, including a group portfolio, which consists of about 25 to 30 companies that the viewers of this channel did choose. And those decisions were made on the basis of they think those companies will outperform the market over the next 5 years. So this is sort of a 5-year experiment. And we're almost 20% of the way through the experiment because 11 months in, I just can't believe. I started this almost 1 year ago, not this channel, but setting up this group portfolio and tracking the group portfolio against the overall market. Also, I've been tracking two of my own personal portfolios, and I use different strategies in regards to those portfolios. I'll talk about that during the rest of this video. And quickly go through the three portfolios that I do track. They include the group portfolio, which consists of 25 to 30 companies that the viewers of this channel did pick, and it is a completely passive portfolio. There is no buying or selling of any constituents within that portfolio. There might be some people who think that's ridiculous because some companies are down 80% within that portfolio. But just because they underperformed over the past year doesn't mean they'll underperform over the next 4 years. In fact, those could be the biggest, best successful companies within that portfolio. So I just want to see how it does perform or how a completely passive portfolio can perform over a 5-year period. My two personal portfolios are using different strategies. The first strategy is sort of the long-time buy and hold. And I've been using that strategy ever since I started investing because, to be fair with you, we are taught, or most investors are taught, that's the strategy you should be using. It is the most successful strategy to use. I have changed my opinion. I believe that is a sort of strategy that does suit a lot of people, but may not suit me. And a few years ago, I started using a more short-term, medium-term sentiment and momentum strategy. And to be honest with you, that strategy has significantly outperformed my long-term buy and hold. And I more than likely will but I will continue using the short-term sentiment momentum strategy more and more in the future. And then right now I am developing a checklist when using that strategy. And when I've completed the checklist, I should completely take the emotion away from any of my decisions. And that is the ultimate goal, to be completely emotion-free when making decisions. Now, before we have a look at the performance of the three portfolios, I just want to focus on how the XGO is performing, sort of a proxy for the Australian market. This is the ASX 200. Now, when you do look at the ASX 200, there's a lot of defensive companies on that index. Defensive companies include, say, Woolworths, Coles, banks, potentially even the miners, like the big miners, BHP, could be a little bit more defensive than other companies out there. And in downtimes, say bear markets, those defensive companies tend to outperform high growth, non-profitable companies. And that's why you might hear a lot of experts this time of year are talking about going defensive. And that's the reason why, because there's a lot less downside if you're holding on to those bigger companies. But if you do use that sort of strategy, you have to be aware that when the market does turn from being either really bearish to being bullish, so if we go back into a bull market, you need to change your strategy from defensive to aggressive, because the defensive stocks will significantly underperform high growth companies, particularly those high growing companies that are unprofitable. Anyway, if we look at the XGO over the last 13 years, this is the monthly chart going back to the middle of 2009, we are seeing the XGO go up through time in this trading channel. And only once in the past 13 years has the XGO gone above or below this channel and that was during peak fear of the COVID-19 financial panic, but it recovered very quickly. And about 7 months ago, after a run of about 11 months up in a row, we did see the SGO reach the top of the channel, which was probably one of the best times to sell, because those are the times to sell when it reaches the top of the channel. And ever since it reached the top of the channel, the XGO has been struggling or has been going sideways. In fact, we've seen 6 down months and 3 up months. But the XGO has not been struggling as much as some of those other indices like the NASDAQ, S&P 500, or even the Australian Small Caps Index, which is the XSO. So over right now, another down month. XGO is down 3%. I forgot to change the month there. So this is from April 29 to May 31st. The XGO is down 3% and finished May at 7,211.2. Before we have a look at the performance of the group portfolio to the end of May, just want to go back 1 month to see where the group portfolio stood at the end of April. And at this point in time, it was up 6.5%, really buoyed by the performance of Lake Resources, Novonix, and BrainChip. In fact, when you look at the performance of the companies within this group portfolio, you can see the majority of companies are down or were down for the first 10 months. So this is a really good argument for diversification, not putting all your eggs in the one basket, although those who put all their eggs into Lake Resources or Novonix would be very happy at this point in time. So up 6.5% at the end of April. How has the group portfolio performed during the month of May? Now, considering the XGO was down 3% for May, we should have expected that the group portfolio performed worse than that, and it did. So it went from being up 6.5% to being down 4.5%. And if it wasn't for Lake Resources, BrainChip, and Novonix combined, they were up $23,000 since the start of financial year. The performance of this portfolio would have been absolutely awful because numerous companies, about almost 8 companies in this portfolio, were down over $2,000, including Kogan, the worst performing company, Zip, Alcidion, Credit Intelligence, Megaport, Imogen Biosystems, Email Payments, Pointerra, all down over $2,000 since the start of the financial year. And there is a common theme among all those companies, except maybe Kogan. Most of those companies, and maybe Email Payments, most of those companies are unprofitable, but a lot of those companies are growing at a quick rate. Now, the thing I really want to emphasize here is just because those companies have performed really badly over the past 11 months doesn't mean that performance will continue into the new financial year. I do expect the performance of some of those companies to turn around, and there is potential that in financial year 23, some of those companies will be the best performing companies in the group portfolio, while Lake Resources, BrainChip, and Novonix might be the worst performing companies in the group portfolio. So I think that is or needs to be emphasized because we have seen that happen time and time again over the past 100 years. And we can just see how volatile the group portfolio has been when we've just been tracking it against the STW. So right now, the group portfolio is down 4.5%, while the STW is up 3.7%. And the STW, which is the ASX 200 fund, has been buoyed by dividends, 4.5% of dividends, because the capital gain in that fund is actually down 0.8%. But when we look at the graph above, you can just see, which tracks since the start of the financial year, the performance of the group portfolio against the STW. You can see when the STW was rising, the group portfolio was rising at a greater rate. But when the STW is falling, the group portfolio tends to fall at a greater rate. That's why right now the group portfolio is down below the STW. When we do see the markets turn around, become more bullish, I fully expect the group portfolio to perform absolutely steadily compared to the STW. So this is not the time, particularly when we are heading towards the bottom. We don't know where the bottom is. This is not the time to become ultra defensive because you're going to lose a lot of the upside when the markets do turn around. Now onto the performance of my own personal portfolios. The first one we're going to look at here deploys the long-term buy and hold strategy that I started using when I became an investor well over 1 decade ago. because this is a strategy that we all get told is the only strategy you should use. And in fact, those experts who tell investors that, I think it is harmful and damaging because everyone is different and there are different strategies out there that could suit you better than long-term buy and hold. And this is something I have found over the last few years, that this is not the best strategy for me. There is another strategy out there that I do better in because it suits my personality. So I think one of the keys to becoming a better investor is to find the strategy that suits you. Anyway, during May, I made one disposal, and that was mydeal.com. There was or is a takeover bid for that company. I thought I'd just lock in profits because there was not much difference between the takeover offer and the share price of that company. So the market is highly confident that that deal will go through. I don't think there is going to be a bidding war for mydeal.com.au. That's another reason I sold. Just locked in profits. And instead of deploying that cash into another business, I just added to my cash pile, which now stands at $33,000. And my plan in regards to that cash pile is when I see the market starting to turn around, sentiment starting to shift, that's when I'll deploy that cash. Now, I do believe you can't time the exact bottom within an hour, but you do have a certain period of time when you can get confirmation that the bottom has been reached. So don't believe anyone who tells you you can't time the market. You can definitely time the market. I have found that over the past decade, over the past 15 years. Now, my strategy has evolved over time. When I started investing, I would buy into the company and really try to hold that as long as possible. Even the only reason I'd sell out of the company is if the story changed. Even if I see the share price run up, say 100% over a short period of time, I'll still be holding onto the company shares, and then I'll see the share price drop 50% over the next month after that. So what I'm doing now with this strategy is if I see the share price of a company rise considerably in a short period of time, gets overbought, I will take profits. And I did that about 5 or 6 times since the start of the financial year. And funnily enough, those companies are the best performing companies in this portfolio. In fact, 6 of the best 7 performing companies in this portfolio are companies I completely sold out of. Beam Communications, Revison, Alexium, mydeal.com because of takeover offer, Ambertech, Australian Clinical Labs, Aussie Broadband, and the other best performing company, BrainChip. We did see the share price of that company rise massively in January, and I decided to lock in some profits, but I was not willing to sell out completely out of that company. So it is useful to be able to change your strategy through time, to adapt, find what works for you. And I think in the long term, if you can find what works for you, you will become a better investor. Now, just like the group portfolio, the performance of the long-term portfolio is highly dependent on the mood of the market. When the mood of the market is bullish, this portfolio should outperform the STW, but when the overall mood is negative or bearish, it should underperform the STW. And we can see this comparing the performance of the long term to the STW. Probably a better way or a fairer way to judge the performance of this portfolio is compare it to the XSO, the small cap index, because the majority of companies that I have bought into using this strategy are small caps. And the XSO is actually down more than 10% since the start of the financial year. But when we do compare it to the STW, the long term down 1.7% compared to the STW, which is up 3.6%. Now, both portfolio and the STW have been buoyed by dividends. In fact, the long-term portfolio, 3.5% increase because of dividends, while the STW, 4.5% increase through dividends. We also have a currency gain in the long term because I actually have bought into PayPal and $50 of currency gains. So exchange rates between Australia and the United States do have an impact on the performance of my own long-term portfolio. Now to the performance of my other portfolio, which deploys a vastly different strategy. This is a more of a short-term, to maybe even medium-term sentiment and momentum. So I am looking at charts and I'm looking at the sentiment in individual companies. That's very important here. So in my other portfolio, using that strategy, the overall macro environment actually is important. But in this strategy, I don't care about the overall macro environment. I am looking at the overall sentiment in individual companies. Now, the macro sentiment can affect individual company sentiment, but you'll be able to tell that if you look at the chart. Now, even though I call this a short-term sentiment, probably better to describe this portfolio or this strategy saying it's short to medium term, because South 32 is the longest holding in this portfolio, and I've held on to shares in that company for almost 2 years because sentiment has been positive for almost 2 years and the share price just keeps on increasing. So in those times, I don't want to sell out because the sentiment is positive and the share price keeps going up. That's the whole point of me using a strategy, is you hold on to your winners for as long as you're possible and sell out of your losers. So if I see sentiment shifting in any company I bought, I shouldn't have a problem selling out of that company. Now, I just mentioned there, I shouldn't have a problem. Sometimes I do. So right now, I am developing a checklist, and I want to be able to follow that checklist blindly. So I take the emotions completely out of the decision-making process. Now, during the month, I did make a couple of disposals, adding cash to the kitty by $3,437. So I do have $8,365 to deploy, and I already have a few possibilities in mind on how I can deploy that cash. So you might have to wait to next month's video to see which companies I did buy into. The two companies I did sell are two losers, Emerson and Mosaic Brands. Not a big loss, but about $300, $400 each. But the reason I sold out of those companies is because sentiment is negative. And even Mosaic Brands, I don't think I want to be holding on to any discretionary retail companies right now. So Mosaic Brands does look really cheap, but just because it looks really cheap doesn't mean share price can't fall further from here. And in the worst case scenario, Mosaic Brands won't exist anymore. And that's probably one of the best reasons to possibly sell out of the company. If you think there is that possibility, it will go to zero. I won't say Mosaic Brands will go to zero, but that is the worst case scenario for this particular company. During the first half of this financial year, I have to be honest with myself that I was not giving this portfolio as enough attention as it should be. So this is a little bit more active than my other portfolio, and I need to be more active. And because I was not as active as I should have been, the performance of this portfolio underperformed my expectations. But as soon as I started putting some time and effort into the performance, or just this portfolio, we saw the performance of this portfolio outperform not only the index, but also my other portfolio. So right now, this portfolio is up 3.9%, which is favorably compared to the STW, which is up 3.7%, and is favorable to my other portfolio. So at this point in time, this strategy is working for me. But I think I can improve the performance of this strategy by developing that checklist. Now to the overall performance of all three portfolios in the STW. I've also included the XSO here, simply because I think I have been thinking about this. I think the performance of my long-term buy and hold portfolio should be compared to the XSO, because most of the companies in that portfolio are small cap companies. And in fact, the best performing portfolio or index over the past month has been the long-term buy and hold. It was up only 0.8% at the end of April. Now it's only down 1.7%, so only a change of 2.5% during the month. The next performing index or portfolio was the STW, down from 6.4 to 3.7%. The group portfolio fell about 11%, from 6.5 to 4.5, and my short-term portfolio are down about 7%, from 11.5% to 3.9%. This is the first time I've actually looked at the XSO, but it is down almost 11% since the start of the financial year. So the very fact that's down 11% and my long-term portfolio is only down 2% makes me think that there is some validity to my long-term buy and hold strategy. So I shouldn't completely dismiss it at this point in time, even though I do think the short-term sentiment and momentum strategy is a better strategy for me. That's all I have for this video on the 11-month performance update to three portfolios, including the group portfolio and two of my own personal portfolios. If you want any clarification or if you have any questions, comments about anything I've mentioned in this video, just leave in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.